Okay, back again. This one, I'm doing a video. It's not actually about trading, but it's about stocks and index funds, stuff like this, like ETFs. If you're watching this, you probably don't know what any of this is, so I'm going to go through it. So, a stock is like you're buying a share of one company. So that could be Apple, Microsoft, any of these companies like Google, any of that bullshit. I mean, you used to have to go into an actual place and you buy it. You go to like a bank or something, and you actually buy it, and then you hold a piece of paper saying you own that stock. But obviously now it's a lot easier. It's online, and to actually buy a stock, how it works is someone has to sell the stock to you. So you have to find someone to sell the stock to you, but your broker will automatically do that. So this is just what goes on behind the scenes. So every time someone sells a stock, you have an opportunity to buy, but because people are always buying, selling, you don't see that. You just see buy and you bought it. So that's what actually goes on. An index fund. So index fund's a little bit different. So index fund is like it's like a mixture of multiple companies. So you're not just relying on one company to do well, you're relying on multiple companies. And these index funds, they're made up by certain people. A lot of them are actually automated. So there's literally computers running this. So you've got the S&P 500, which is the top 500 companies in America. You have the FTSE 100, which is the top 100 companies in the UK, which is also known as UK 100. And you've got all of these other ones, upcoming ones like all these Korean ones, which I will talk about. But obviously, if you want to invest and you have a choice to invest between stocks and index funds, you want to invest in an index fund because it's so much more reliable. With stocks, you're relying on one company. If that company goes to shit, something bad happens, then there's very high chance you could lose all your money. It's unlikely, but with an index fund, that's pretty much impossible because you're relying on multiple companies, and every time the company's doing so bad, automatically there's a new company that gets put into that list of companies. So it's always going to be a bullish market for the S&P and most index funds. A lot of them you would literally just see it's very slow. It's not you're not gonna become a millionaire overnight from it, but it's very stable and it's a good place to put your money in because with inflation, you have say $1,000 and every single year that goes down a certain percent. I believe it was 3.8%. I think, or 2.8% every single year. That's the average percentage. That so that $1,000 is losing around 2.8, 3.8% of its value. So it's actually worth less. Every single year this happens just naturally. And you could have your money invested, not invested, but you could have it in an account where you get some sort of return on that. And you may think, oh, great, I've got one of these accounts. But with that account, you're still losing money every single year without even realizing it because of inflation. So you want to avoid that, then you want to invest in an index fund. And I'm not forcing anyone to, but if you clicked on this video, then you're trying to learn about it. So I'm gonna tell you everything I know about it to give you a better understanding. So it's better to have your money in an index fund because your money will compound. So you'll make maybe okay, for example, you put $1,000 in. Next year, 1 year passed, you made $100. Now now from that year there's another year and you're making more money from the $1,100 and it just keeps going up and compounding and it's like a snowball effect almost. So if you keep putting money in, so you can do it however much you want to. If you have a lot, then obviously do it more often. But if you don't, then that's okay. You can put some in every single month. Even if you start, there's no harm in starting because your money's just going to be sat there making money. So let me put this simplest way. You put $20 in every single week and you keep doing that over the course of 50 years. It may not mean anything to you whatsoever. but at the end of that 50 years, that's gonna be a couple 100,000 definitely. I mean, I can try and work it out. So how many weeks in a year? We'll go 48, I think. 20 times 48 times 50. I said 50 years. And then, okay, so I think it's around, I'm going to double check this because what percent does, I think it's quite a lot, or at least very steady. Should be quite a bit. 11, okay, fuck me. 11%. Every single year from putting your money in the S&P, you're making 11%. So I'm probably going to get this. This is probably wrong, but it's kind of it gives you some sort of idea of how much you've been making. So I'm not smart enough to actually do it from my head, so I'm going to use ChatGPT. If I invested $20 every week into the S&P 500 for 50 years with a yearly return of around 11.1%, how much would I have? And that just kind of goes to show 11% every single year from just having your money sat there. But the thing is, if you have your money in an index fund, you don't want to touch that money. You want to literally just leave it there and let it keep piling up, piling up. It's not like something where you can take money out whenever you want. If you want to invest, you invest for a long time. So anywhere from 5 years. And before you do it, you should also have kind of an idea of how much money you want in that account, then you can withdraw it. So say you want your goal to be $100,000, $10,000, or $1 million, however much, and you just leave it in there until you've reached that target. And I promise you, your future self will be thanking you so much because you could retire early. I promise you that if you did this every single, like, you don't fuck the pension, you could literally just live off this the rest of your life. I swear. So, oh my. Okay, so I said $20 every single week for 50 years. Estimated final amount is 2 point, you see that? 2.38 million. 2,380,000 in 50 years from just putting in $20 every single week. Like that, does that just not blow your mind? Because 11% average return every single year, 2 million. I'm even surprised myself by that. I thought it was going to be a lot lower, like a few 100,000. That's crazy. Okay, so we're going to go on to the charts. I'm on my demo account because I don't want to show any of my balances or anything like that. But I'm just going to go through a few things that I personally like to invest in. So obviously I do day trading. So instead of putting my own money in, I trade, and whatever profits I get, I'll put it into the S&P every single day. So I made, I think it was $20 today, and I made $25 yesterday, but it was a bank holiday yesterday, so I couldn't actually put anything to S&P. So I put in $50 today, and I just keep doing this, and eventually it's gonna pay off because I'm doing more than that, $20 a week. This should be, I want to say 8 figures one day, but you never know because I mean it's supposed to be the safest thing to invest in. You can't see my screen, right? Okay, cool. Right, okay. So if you want to invest in the S&P, a lot of people get this mixed up. This is not what you want to invest into. This is an indice. So this is, you don't want to invest in this. You want to invest because this is not an index fund. This is kind of this is the S&P, but you want to invest in something that replicates the S&P. This one is literally for day trading. So you'll see here, you can see, okay, so I'm on the weekly one, and you can see, so because of the war, every single S&P related market and a lot of these index funds, they all have this little dip there. And I've got a few other ones to show you, but you can see with this market that it's very steadily going up and up and up and up every single year. Because look, you can see when it started, look, and look, it does have drops like this. It does, it will, but that is the perfect time to buy because a lot of people think, oh shit, like it's gonna keep going down. But that is so normal for the markets. It will just sometimes drop, sometimes there'll be really heavy news. This was in COVID, so COVID caused it to drop a lot. And then again with the war, there was this drop here. And you can see how sometimes big news events can sometimes cause it to go down because a lot of investors, they don't feel safe with investing in that company. They feel a little bit cautious in a way into investing into the index funds because they think that a lot of these companies are going to go bust because of certain news events like COVID, how the companies can operate normally, the war, they thought that all the oil shortage was going to mess up the companies. So that's sometimes what causes that little dip, but it always recovers every single time. Unless there's some crazy apocalypse or something, then it will always recover. I mean, you see here, sometimes it will have a little dip here, and it will go on for maybe 1 year, 2 years. But if you're investing over 50 years, it is impossible that you're not going to make money from this. I mean, at the moment, it's trading at, it depends what you go on. So you want to invest into the ETF one. So this one here. So this one's an ETF. This is not your day trading chart. This is it kind of this market kind of replicates the S&P in a way. So you'll see. So I was talking about that dip there, and you can see that right here as well. So this replicates the S&P, but this one's more of the long-term growth stock, and you can see how the numbers differ because that one was 7,000. So this one is the one I would recommend to invest into. This is the safest one. You literally cannot go wrong with it. It's one of the biggest things, and I'm sure most of you know exactly what the S&P 500 is. But for those of you who don't, that is what it is. So some other ones. So you've got this one's the FTSE 100, but just like the other one, this is you don't want to be investing in this. This is more the actual day trading one. So I don't know what the hell I was doing here one day. Right. So you see again, you see that little drop from the news, from the war, and then it goes down, and then it always recovers. And you can see how it's very steady. But obviously this is different because this tracks the top 100 companies in the UK. So obviously it will always be going up, always. Exact same thing. So on my watch list, I have a list of very good ones. So this one here, I invested into this one the other day. All of these markets, they're up and coming, and I've always had such good results with them. So in the last couple of days, I've made 12% return on these ones. So it's the Korean one, because the Korean and all of these Asian countries, they are still up and coming and they're still developing. So if you invest in a developing market, you will see some very big returns in a short space of time and very consistent ones. So I have one. I invested in this one, and I'm also invested in this one. The Japanese one I've been investing in for a longer time, and I made a 20% return on that. This one I've been invested in maybe a couple of days, and I made a 12% return on that. And this is not financial advice. I'm not guaranteeing that this is going to happen, but for me, this has worked. So sometimes I know when the market will go up. So when the market kind of has a dip like this, and there's some sort of news going on, you want to buy. I promise you want to buy, because you see right here how, because that's called a new week opening gap or a new day opening gap. Sometimes it will jump up like this, sometimes it will drop, but you can see again, obviously this is very new because it's only opened it on the 9th of December 25. But you can see it's consistent, and I can show you the other one as well. So they're all very consistent, and a lot of these don't look the same. They don't look similar to the actual trading markets because I can't fucking tell you, but it's kind of because it's I want to say lack of liquidity, and because with day trading, people are kind of doing very short trades like partials and stuff like that. They're not really trading like long term. Yeah, some people are, but these ones are more long term, so there's less liquidity, is more steady growth. And that's kind of the way I look at it. So yeah, you see this one, I'm invested in this one as well. And again, this one's also quite new, but you can see it's very steady. And I invested, I want to say around here, December. So I invested, must have been down here at 19. And then I think I did sell some, maybe at 22 or something. And I made a really good return on that. So they are three or four ones that I like to use, and I'll show you the last few because I don't want this video to get too long. So you'll find it on ETFs on whichever broker you use. I use eToro because I've always used it and I do like it. Okay, so the next one is this one. So this is another S&P 500. It kind of mirrors it again like the other one. So you've got that one. It's this one. You don't want to get the wrong one. You can, but it's better to go with this one. So this is the one I showed you earlier. This is another one that also mirrors the S&P, and you can see how their return rates are very similar, 31. Again, another one, S&P 31, and you can see how steady these are and how they all mirror each other. This one is more reliable in certain ways, but I find this one it's a little bit slower. And again, I'm not a professional at all with any of this, but I'm just telling you what I've noticed and what I've learned over the time I've been doing this. So okay, again, you see, sometimes it will drop, but it always recovers. Again, you can't go wrong with investing in S&P. You cannot. It's literally if you genuinely want long-term growth and you want to invest properly, then you invest in the S&P. And again, this is not financial advice. It is. But and again, I'm not telling you to copy any of my investments or anything like that. But these are ones that I know are good. And if it's going to stop people investing in the stock and they're investing in an index fund instead of a stock, then that's good because stocks are more unreliable. And again, you see that little dip there? Every single one, because this also mirrors the S&P. This is some of them are different. It's hard to explain, and you're probably better off watching someone else's videos on this. I know there's one guy called Mark Tilbury. He goes through all of it really well, a lot better than I do. He will tell you the exact same stuff that I told you, because everyone knows that these are the top ones, and some people might have some other ones which are even better and they're upcoming, but this is I just tell you the safest way and the most probable way of you going to get a return. This is the last one. This also mirrors the S&P. I know I've invested in this one. I think I've done a 10% return on at least all of these within a couple of months, weeks, anything like that. So I do find these really reliable. I'm going to end the video here. If you found this useful, then that is amazing. And leave a comment on anything you'd like to see next, because I'm struggling for ideas. I do want to do some more trading stuff, but I thought I'd make one about stocks and shares and index funds and stuff like that, because I know a lot of people, they don't know anything about it. But like I said, you're better off watching someone else's video. But everything I said here is pretty much what they're going to tell you, but they might explain it better than me because I'm really bad at explaining things. So if you like the video, thumbs up, subscribe and comment if you'd like to see any other videos. But I will see you later.